Hello traders, Mark Keyworth here from Flipside Trading, and it is Sunday, November 22nd, and we're back at you. Hey, pardon the hiatus, but I went back to coaching high school football this year in the year of the COVID. Crazy season as far as being on again, off again, but we did manage to get 6 games in and finish 4-2. Did miss the playoffs, unfortunately, as they only took 8 teams, basically starting at the quarterfinals, but overall, a great time, a great success for the boys, and a pleasure to be a part of the Windsor experience. So let's talk more about the markets. And so the key thing we want to talk about today is that right now we're seeing kind of a chop, a little bit of a consolidation. There are pockets of momentum that do provide some opportunities. We'll talk about that. We'll talk about the effect of COVID is having in the rising number of cases versus what's the hope, right? With the vaccine and stimulus, in the future, can that be offset to the near-term COVID impacts? We'll take a look at our new economy and our update from an overall long-term investment standpoint, and then we'll take a look again short-term at anatomy of trade in FedEx. So let's get right down to it, and let's start with what we're seeing in the markets today. So right now, right, everyone I'm sure is well aware that COVID cases are spiking, right? Regardless, even with increased testing, we're still moving up and to the right at an exponential rate. At the same time, it's not happening just in the United States. It is happening worldwide. We're just showing Europe here for an example. So what does that mean? Well, it means that, we're going to have more and more restrictions. Does it mean that we're going to have a shutdown like we had in March? Probably not. I think that with the new testing advocates, people are looking at kind of micro-targeting and looking to shut down specific geographic areas versus a blanket-wide economic push. But that does put an overall drag on the economy and therefore output, therefore people earning money. And since the economy is 70% of consumer-based, there is a function there. Now, the Fed has come out and said, right, hey, we're going to do everything possible. We have a lot of tools left. We're ready to pull it out. The balance sheet is still increasing. They're going to buy like crazy. But the Fed is also saying, look, guys, we can't do this alone. We do need fiscal stimulus because our policies and what we can do only helps the business side, and the consumer side needs to be propped up as well, or else there are no buyers for goods and services. And people can't pay just basically their, the normal everyday, from groceries to rent. Unfortunately, there's going to be a gap there because that's not going to happen anytime soon, given the uncertainty around the election certification process and the protests that are going on there, and just the politics of who gets credit for a stimulus. That's not, kind of in the near future. We do have vaccine hopes. Okay, we've seen that both Pfizer and Moderna have come out with vaccines based on preliminary tests that are 95% effective, but there's a manufacturing, transportation, and distribution piece to this that's huge, and that's not going to really happen until kind of late Q1, early Q2. Even then, as vaccines become available, they will be prioritized mostly to kind of frontline health workers, first responders, and teachers, which keeps, I think, which has to be done from a fundamental standpoint from the underpinnings of keeping the overall social economic structure safe. But it's not going to provide a huge boost to the economy until we have more widespread acceptance and an actual use of the vaccine. So basically we had this gap, right, between now and let's say till June. So the question becomes, does the market discount that period and say, hey, we know that we're coming out of this, so therefore we're going to keep buying? Or does it adjust and drag for COVID? So that's the question before us. I don't have an answer for that, but I think what we can say is, given that we have uncertainty and that the market is in an uptrend, but it's overbought, we'll take a look at how overbought it is in a second, I think that the higher probability case is to see a potential chop and some pullback to digest and wait to see how this is going to play out. At the same time, you'll get rid of that overbought condition and allows you to go forward in the future. So, that's kind of where I'll be leaning, but I'm not going to make a bet on that. But we're going to look at triggers, and once we see those triggers manifest themselves, then we'll go ahead and take action. So we'll talk about those triggers as well. So let's get down to it. And let's talk first about the market being in an uptrend. So let's go back to our dashboard, and you can see here we're at the McClellan Index for the New York Stock Exchange. And the key thing that we definitely want to see on this graph is that, right here we have, that summation index is above the moving average and is moving higher. You can see here, on the SPX below it that we're kind of in this flagging area. We kind of broke out a little bit. We're retesting. The question is, can it go up and continue? So the market is definitely, still in an uptrend. Now, we also could look at it from the standpoint, my favorite near-term piece, that was a weekly, is are we above the Keltner channels? And yes, the answer is we still are. That our envelope based upon our market breadth is still above the Keltner channel. So we still have the possibility of moving higher. We're not in the channel, and we're not below the 20-day moving average of that channel, and we haven't broken below it. So yes, we are in an uptrend. And I guess the last one that really kind of confirms it for me is if I take a look at let's see if I can find, is Mr. Copper, right? Copper has a PhD in economics. You can see that copper is still, moving up, in a very, very straight line here. And of course, the index is, below it as well. So those things still say we're in an uptrend. But the question is, are we overbought? And the answer is absolutely yes. And so let's take a look about what that means to be about being overbought. And we'll take a look here. So what we're looking at here is in the upper graph, looking at the SPX, and we're looking at what we have here in this blue line is a 21-day moving average. So as we know, markets cycle. They don't go in one direction. They basically kind of revert to the mean. And so in this case, we're showing that, basically from a mean reversion standpoint in an uptrend is that the 21 EMA seems to be about the right fit, all right? Every time we get too far above it, right, it pulls back down to the 21 EMA. We get way above the 21 EMA over here, right? And what do? We pull back. Now, what I've plotted down here in the bottom is actually the percent distance above that moving average. So you can see here that once we get, really above that 4.5%, 5%, is that it starts then to move back down to zero, i.e. touching the average. So what we've done is we've seen here, we've kind of triggered it again, and we've hit that 4 or 5% above that moving average. So statistically, it says that, we're probably headed back to a pullback to the zero line, which is the zero line in this case is the 21 EMA, and that would mean revert back here, which kind of fits into a chop. So there's some history for that, coming forward. The next thing is that if we take a look at, there are no more sellers in the market, right? You take a look at right here, the short interest in the S&P, it continues to fall to new lows. Well, if everyone's running to one side of the boat, the market doesn't like that, right? The market likes to, basically cause max pain. And if everyone is on that right side of the boat buying the market, well, you know what, then it's time to shake out those hands, and the overall kind of sentiment and the market psychology from the institutional investors would be somewhat of a pullback. Now, the question is, let's take a look at another piece on that, and let's see, where am I? Let's go back over to here. And there's one more chart I wanted to show you, and that is here on the 200-day moving average. Now we look at the stocks here. Okay, this is the percent stocks above the 200-day moving average. You can see now we've moved into the 90% range. And when we get to be, this overbought, can the market stay overbought? It can, but if there are no sellers, and we talked about everyone, oversubscribed to the long position, well, the market potentially might want to come back. So is there more evidence to say that the 21 EMA is a good place for the market to pull back? And so technically the answer is potentially yes. And so let's take a look at that. And we're going to look at the S&P 500 futures. And we can see here, that where we are right now is that we're still in an uptrend, right? Here we are with our basically, kind of higher, basically higher lows and higher highs. We still made that. We're starting to pull back a little bit, and we're pulling back, to key areas, right? We can't get back above this resistance level here, and we found some support. The question is, can we fall back lower? And the answer is yeah. I mean, we have the 21 EMA right here. But we also have the top of value right in that same area in this 3,500, 3,505 range. And what that tells us is that this overall value area represents where 60% of the transactions happen for the S&P 500, which represents really fair value, right? And this is kind of the borders of that fair value. So we're saying that this can serve as overall support as it comes back down, number one, along with the 21 EMA. Now, if we break that, and chances are we could, right? Because the market always has a ability to, should we say, overextend and over below, is the next area is right here at the 50 EMA, which is all 50 EMA, which also is at the POC, which is at the point of control. And so now we're not, instead of being within one standard deviation, we're 70%. This is the spike, right? This is the area, this price at the 34.40, basically for the past month is where really what considered fair value in the S&P 500. So to see that happen and pull back, to those areas makes a lot of sense. Now, if we go below these areas, this is where, right, if we go below 34.40, this is where I start changing my tune and saying, okay, now potentially we are not out of an uptrend, that we are in a correction, and we are going to discount what's happening with COVID at almost immediately, going forward. And then, of course, the first line of support would be here, kind of at 33.40. So basically it would drop down another 100 points. The other thing we can look at is also our fibs. So if we take a look and add what the fibs say, and let's add that drawing here, right, from that low to this high, you can see that we also have an additional, should we say, confluence of support levels at this 34.40 level, which now we have three things, right? We have the 50 EMA, we have the POC, and we also have the 50% retracement. So those three things really say that this is kind of our key trigger point overall. So that being said, if it can it go higher? Obviously, yes, the market can always go higher. And so if I say where we go to the high point, I have to take a look at the fibs, and you can see that we've, right now we're kind of hitting this point of S1. And if we pull this all the way down and say, where is S2? You got kind of 35.80. That's a little bit high. I think I would kind of look at overall what my extensions would be in the other direction. I'd say if I went from here and I drew my fib down to this low and look what my extension would be, you can see, look, the 127 extension really held us right here at 36.26. It also matched with the S1. So if we broke 36.26, then our next target would be 37.56. So those are kind of the levels that I would use, right? If we're going to go higher, we definitely have to break 36.26. My key support to say that we're still in an uptrend, and it would be 34.40 right here. So I think that's kind of where we're set. So that being said, we said there are pockets of overall momentum, and let's go back and take a look at where those may be. And let's do that by looking kind of at our new economy dashboard. And if we come here to our list, I got it as a chart book. Let me go to a summary page. And if I go to summary page, and if I look at, basically for the week, and let's see, hold on. There we are. So with the new economy for the week, so you can see that alternative energy / solar, right? Kind of being highest, your online betting, doing well. Some of your cloud and your software pieces, were big. Your automation, again, automation from the standpoint in software, right? If you can't have people in the building, you need to find out how to do things in a way without people. That means automation. Software the same way, not only to collaborate kind of out of the office, but how we get more productivity, and how do we automate those robots. You need software to control those robots as well. And you can see, unfortunately, is that S&P 500 is way down here. So overall, we are still kind of holding this basket of funds. has done us a really nice job in outperforming the S&P 500. Kind of your broader technology is down, your consumer discretionary is down, Amazon is down, and some of your healthcare. If you look at this from a perspective of how are we year to date, we come here, and you can see that the S&P 500 is way down here, right here, and we are vastly outperforming that. And the way that I've had most of my portfolios structured is that the S&P 500 is doing about 11%, and my portfolios are doing somewhere between 26 and 30. So that is a good help. And we've seen going forward, besides those key areas moving, of course, if you look at Dow theory, it's a kind of rotation back to what may be happening kind of out of tech. If you look at what was happening, is that you kind of see two areas. I saw consumer staples, which is XLP. They're kind of moving out to a new high as well, and you'll see that they've bounced up here, right? They broke the new high, right? That actually closed above it, which we haven't done, and the S&P 500. And of course is the transports. And when we talk about the transports, they were moving. They're moving at kind of 150, 160 points, a day moving forward. So based on that, and seeing that once they broke, this piece here, what I do is I look for, okay, let's try to find a stock that is within this group that makes sense to think about it in purchase, for the ride up through the broader industry group. Because what happens is usually there are 2 or 3 stocks within a sector that drive the overall sector. Well, that stock in this case was FedEx, and I went ahead and tweeted this out back on November 19th, talking about that the larger market piece that we saw moving was the transports. And basically, we talked about that we had a couple different things going for us, right? Basically, we had this trend line here because we had basically lower lows. We got a lower high, but we got basically kind of a lower low. So now if we're going to continue the trend, it would break upwards, right? We always want, when we talk about, we have a squeeze down here. We have a squeeze that talks about consolidation. We want to be above the 8 EMA, and we want to be above the VPOC, the POC here. So that would be this area right here. So we got that trigger. And we got that trigger, and we move forward, and we entered into here like on the 19th. And so our targets were basically twofold. We said our target was number one, this previous high, so we took off here, and then of course the top of value. So we basically hit both those targets. And the great thing is, if you take a look at this and how much FDX mirrored, remember, right? We talked about being the top of value, right here being the overall target. Well, if we kind of move back and we go back to transports, and watch exactly what happened here. Transports will come back up, and we had the same type of thing, is that they didn't have, top of value, but they did have right here the overall, basically R1, right, resistance area 1. And so knowing that we had that level above, it really corresponded in a time perspective that this sector has reached its top, and it corresponded very well again to what we saw on FDX meeting its top of the value area, and that was a good time to exit and take targets. So it's a great way to look at your overall drivers, in a market sector when you're seeing those types of pocket momentum. Finding a stock that has consolidation and a squeeze, in an uptrend, waiting for those triggers, to occur, and then getting in, and then obviously having, target set out here at this, key resistance area based on that preliminary active high, and then overall, here based upon the value area. So going forward, what I see for next week is a shortened holiday week. I probably would see the market grind maybe a little bit higher just because it's with Black Friday and all the consumer action, that's happening, next week. Overall, though, I would look for kind of that pullback before we see, that level going forward. Look for those pullbacks at those two key areas. on the S&P 500. Number one here at the top of value around 3,500, and then of course at the 3440 level is kind of the second one that I'd be looking for, up above here, above 26. So there you have it. Good luck this week. Great talking to you. Great to be back, and we'll catch you on the flip side. Take care.